Welcome to our comprehensive guide on interest. Whether you're looking to understand how interest works in your savings account or how it impacts your loans, this video is for you. Let's dive in. Let's start with the basics. What is interest? Interest is the cost of borrowing money, typically expressed as a percentage of the principal, which is the amount of money borrowed or invested. There are two main types of interest: simple interest and compound interest. Simple interest is calculated only on the principal amount, while compound interest is calculated on the principal and also on the accumulated interest of previous periods. Let's look at how these work with examples. First, let's explore simple interest. Suppose you invest $1,000 at an annual simple interest rate of 5%. To find out how much interest you will earn after 1 year, you can use the following formula. In this case, the calculation would be $1,000 times 0.05 times 1 is equal to $50. So, you will earn $50 in interest after 1 year. Now, let's look at compound interest. Assume you invest the same $1,000 at an annual compound interest rate of 5%, compounded annually. The amount of money after 1 year can be calculated using the compound interest formula. Here, the calculation for 1 year would be $1,000 times 1 plus 0.05 caret 1 equals $1,050. Notice how the interest earned is slightly higher due to compounding. To illustrate the power of compound interest over time, let's look at an example with a graph. Suppose you invest $1,000 at a compound annual interest rate of 5% for 10 years. As you can see, the investment grows significantly over time thanks to compound interest. Next, let's address some common questions about interest. Question 1. What is the effective annual rate, EAR, and how is it different from the nominal rate? The effective annual rate, EAR, is the interest rate that is adjusted for compounding over a given period. It reflects the actual amount of interest earned or paid in a year. The formula to calculate EAR is, for example, if you have a nominal interest rate of 5% compounded quarterly, the EAR would be. Question 2. How does inflation impact interest rates? Inflation erodes the purchasing power of money over time. To compensate for inflation, lenders typically require higher interest rates. This ensures that the real value of the money they get back is at least equal to what they lent out. For example, if the inflation rate is 2% and the lender wants a real return of 3%, they will set the nominal interest rate at around 5%. Question 3. What is amortization? Amortization is the process of gradually paying off a debt over time through regular payments. These payments cover both the interest and the principal amount. For example, let's say you take out a $1,000 loan at a 5% annual interest rate to be paid back over 1 year. Your monthly payments would include both principal and interest, decreasing the principal balance over time. To better understand amortization, let's look at an amortization schedule. In the first month, a larger portion of your payment goes toward interest. However, as you pay down the principal, the interest amount decreases and more of your payment goes toward the principal. By the end of the loan term, the final payment is mostly principal. Here's a simplified example. Imagine a $1,000 loan at 5% annual interest, repaid with monthly payments over 1 year. The total interest paid would be about $27.22, and your monthly payment would be approximately $85.60. Hopefully, this example makes the concept of amortization clear. Lastly, let's discuss how interest rates are determined. Interest rates are influenced by a variety of factors including economic conditions, central bank policies, and market demand for credit. Central banks, such as the Federal Reserve in the United States, play a crucial role in setting interest rates. They can raise or lower the federal funds rate, which is the interest rate at which banks lend to one another overnight. This rate serves as a benchmark for other interest rates in the economy. Economic conditions also play a significant role. During periods of economic growth, interest rates tend to rise as demand for credit increases. Conversely, during economic downturns, interest rates usually fall to encourage borrowing and investment. To understand market demand, Consider this. When people are more inclined to save, the supply of money increases, leading to lower interest rates. On the flip side, when people prefer to borrow, the demand for money rises, pushing interest rates higher. We've covered a lot of ground today, from simple and compound interest to effective annual rates, inflation, amortization, and factors influencing interest rates. So, what should your takeaway be? Understanding the types and calculations of interest can significantly impact your financial decisions. Whether you're saving, investing, or borrowing, always pay close attention to the interest rates and formulas associated with financial products. Thank you for watching our comprehensive guide on interest. If you found this video helpful, please like and subscribe for more financial wisdom.